Hello guys, welcome back to our YouTube channel. Today's topic is high risk investment with high return. Now let's start. Section number 1. The mandatory compliance. Disclaimer. Before we dive into the deep end of the financial market today, let's get something straight. I am not a financial advisor. The content in this video is strictly for educational and entertainment purpose only. High risk investing involves a very real risk of losing your capital before you put your hard earned money into anything. You must do your own self research and consult with a licensed authorized financial advisor. Do not risk money you cannot afford to lose. Alright, now that we have that out of the way, let's talk about high risk, high return strategies that are shaping the market right now. Section number 2. The truth about the high risk investing. Everyone want to find that next assets classes that goes to the moon. We see the headlines, we see the social media post, and it's easy to get catch up into the hype. But in the real world of the finance, high return never comes without a matching level of high risk. If someone promises you guaranteed high return with zero risk, run away. That's a massive red flag. When mainstream institutional investors talk about high risk assets, they are not talking about gambling, they are talking about asymmetric risk. This means you accept the very high probability that an investment might drop significantly or even go to the zero in exchange for the chance that it could multiply by 5, 10, or 20 times if things go perfectly. The secret of surviving this space is position sizing. True high risk investors rarely put more than 1 to 5% of their total portfolio into these volatile plays. They build a rock solid foundation first with bond market index funds, and then they use a teeny slice of their capital to chase aggressive growth. Now, section number 3. Tech innovation and venture capital processes. Let's look at where the aggressive capital is flowing in the US market. The first major bucket is cutting edge technology. They are talking about micro cap tech stocks, early stages of artificial intelligence, infrastructure, quantum computing, and biotech firm waiting for FDA approval. When you invest in a micro cap company, you are essentially acting like a venture capitalist. These companies usually have low liquidity and massive price swing. If a biotech company successfully faces a third clinical trial, the stock price can skyrocket overnight. But if the trial fails or FDA denies approval, the stock can crash at 80% in a single trading session. To look for these opportunities, retail investors often use specialized screeners or look at them thematic exchange traded fund that focus entirely on disruptive innovation. The key here is checking the company cash burn rate. If an early stage tech company is running out of cash and has issued more shares or taking high interest debt, your investment can get heavily diluted before the technologies even hit the mainstream market. Now, section number 4. The evolution of digital assets. You cannot talk about high risk, high reward option without mentioning digital assets and Web3 infrastructure. Over the late sorry last decades, this assets class has created historic wealth, but it has also wiped out billions of dollars from unprecedented investors. While blue chip digital assets like Bitcoin have gained significant institutional adoption through US sport ETF, the broader digital assets ecosystem remain a wild west. We are talking about decentralized finance protocols, smart contract platform, and layer 2 scrolling solution. The return here can be breathtaking because these network operates 24 into 7 on a global scale. However, the risks are equally structural. You face smart contract vulnerabilities, regularity shift from agencies like the SEC and extreme market cycle driven by pure sentiment. If you choose to explore this space, the rule of thumb is sticking to projects that have real utility, active developer community, and actual transaction volume rather than chasing speculative hype cycles that disappear as fast as they arrive. Now, the section number 5, leveraged strategies and alternative market. Another avenue is stationary aggressive investor look at the leveraged ETF and option trading. Leveraged ETF are designed to multiply the daily return of an underlying index like S&P 500 or Nasdaq 100 in the index goes on percent. But here is the catch that catch beginners of ground volatility delay because these fund remembers daily. If the market moves sideways or expenses heavy chopping back and forth, you will lose money even in the index stay relatively flat over a month. These are strictly short-term trading vehicles, not long-term but an hold investor. Then you have alternative physical market like fractional real estate, crowdfunding, or distressed debt. These markets offer high yield because your capital is looked up. It's called an liquidity premium. You get higher expected return preciously because you cannot easily sell your assets and cash out tomorrow it, if you suddenly need the money. Now the section number 6, practical risk management and conclusion of this video. If you take away one lesson from this video, let it be this: high risk investing is a psychological game. The math is simple, but managing your emotion when your portfolio is down 30% in a week is incredibly difficult. Never chase green candles. If an asset has already surged 500%, you might be buying at the absolute top right before early investment. Focus and asymmetric setup. Now, thank you for watching this video.